Last week, India's central bank cut its rates for the first time since 2020 as the situation goes from bad to worse. Stocks there are getting hammered. The rupee continues to crash and crash even more, to the point that this week, the Reserve Bank of India had to intervene in the currency markets to the tune of maybe as much as $15 billion. Consumer prices negative each of the last 3 months and at an accelerating pace, raising the probability of maybe even some short-run deflation despite the currency's plunge. As one chief investment officer in New Delhi put it, the market is in a panic mode. The economic data has continued to reinforce the troubling prospect India's government-fueled boom of the past few years has failed to achieve the intended spillovers and multipliers, another lesson in those. The private economy remains underwhelming, to put it kindly, and where it has gotten a boost, that's from a shadow credit boom, itself potentially reversing too. Interbank liquidity remains unusually tight, thanks in large part to the central bank's ill-fated currency interventions. RBI is trying to juggle a currency that continues to spiral, and then the negative monetary effects of the massive liquidity vortex all that creates. So yes, as we feared, India is a growing mess, and one that is spilling over to its neighbors and its peers. Stocks in emerging Asia, for example, they have started to really struggle too, and this time we can't blame it all on China. It certainly doesn't help that these two Asian giants, China and India, the one the world's former growth engine, and the other the country many are touting as its next one, it doesn't help that both China and India suddenly forgot how to grow. Where have we heard that before? And in response to countries that suddenly forget how to grow, central banks respond in the only way that they know how, the only way they really can, and that's with cutting their policy rates. And that's exactly what the Reserve Bank of India did for the first time since 2020 last week. They lowered their policy rate by 25 basis points. However, RBI Governor Sanjay Malhotra reiterated the fact that the Reserve Bank of India's focus is mostly on price stability, and price stability goes along with currency stability rather than purely facing up to economic weakness. Now, the fact that they cut rates at all suggests that the weakness has gotten to be such a big enough concern that it forced a policy shift to begin with. However, as he said, their overall stance is going to continue to be neutral rather than accommodative, because again, they're more focused and more worried about what happens in terms of consumer prices, though they can see the weakness is really starting to seep into a whole bunch of different places. In fact, it's hitting the stock market as well as currency markets. That's really where all this selling is coming from, whether stocks or the currency. It's coming from fears that the economy is not as robust as has once been assumed. That when the government started the economic boom over the last couple of years, it really was just the government that contributed to it, and the private economy really never actually took off. So there are a tremendous number of dangers, both inside as well as outside of India, that the Reserve Bank of India is trying to juggle in all of these different ways. A weak currency, weak market, weak economy. What the hell do they do about all of those things? So you got a real downside acceleration in India's rupee. Back on January 24th, the rupee was about 86.20, and then it really took off to the downside, falling to 87.79, obviously a new record low on Friday. And then Monday morning, it opened even weaker. And just for reference, the rupee had been 84.24 back on November 25th when this latest leg down really got started. It has really tumbled to the downside here among the weakest currencies that there are out there against the US dollar. The US dollar has not been kind to the rupee. So you had 87.79 on Friday, and then a weak opening Monday morning Delhi time. And suddenly the Reserve Bank of India, though it does not want to intervene directly in the currency markets, by many reports, and you can actually see it on the intraday charts, the Reserve Bank of India came in heavy and intervened right from the get-go on Sunday night Eastern time, Monday morning India time. So right around 11:45 p.m. Eastern time Sunday night, you can see a clear as day, a pretty sizable intervention in the marketplace. It didn't really generate the kind of strength the RBI was looking for. So same thing Monday night Eastern time, right around 10 p.m., an even bigger intervention into the marketplace. It pushed the rupee down from 87.57 as it was starting to get weaker again, got it from 87.57 all the way to 86.75. And that was followed up by what looked like another intervention Tuesday night, right around 9:55 p.m. Eastern Time. And these interventions, though they weren't made public, have been widely reported because they were spotted in the marketplace to begin with. And because they were so big, I mean, everybody couldn't help but notice what was going on. Here's one media report. While the RBI didn't disclose the magnitude of its intervention, the head of Treasury at Finrex Treasury Advisors estimated it could have been as much as $11 billion over 2 days, which he said are levels not previously seen from the authority. The dollar sales by the RBI may be more than $10 billion, DBS said in a note. And I've seen other reports that suggest maybe as much as $15 billion. The RBI decided to intervene on Monday and Tuesday after spotting what they claim is an unusual buildup of speculative positions, which put added pressure on the local currency, this person said, asking not to be identified because they're not authorized, and same thing you always hear. The central bank won't hesitate to intervene significantly and suddenly to prevent an accumulation in speculative bets, the person said. And the market was expecting, to be fair, that the RBI condition under Malhotra was going to be more hands-off. The policy would be more hands-off. So you can see why Malhotra wanted to make a big display in the marketplace saying, maybe I'll be hands-off and I won't be as aggressive as Das had been, but that doesn't mean I'm going to just let the rupee drop more than I think is necessary or more than I think is consistent with the market fundamentals. So they're blaming speculators who made a huge contribution to the FX intervention. And for now, for the last couple of days, it's got the rupee at least stable. However, there are negative consequences for doing this. The same consequences that India has been facing, like China, over the last several months. Interbank tightening. Because the dollars that get sold into the marketplace for rupees, the rupees the central bank buys with those dollars, end up being taken out of the marketplace and sort of locked away as collateral for the dollar stuff. But essentially, the rupees come out of the interbank marketplace at a time when India is experiencing a seasonal bottleneck to begin with. And so as it's trying to juggle this weakness in the currency that just won't go away, in fact, it continues to get worse, raising bigger and bigger interventions, as it's trying to juggle that, it also has to deal with this interbank tightness. As Reuters reported just today, India's central bank hiked the quantum of funds that it intended to inject into the banking system through an overnight infusion on Wednesday after aggressively intervening in the foreign exchange market the last 2 sessions. That's Monday and Tuesday. And again, I think there was a third one there. The Reserve Bank of India had offered to pour in 2.5 trillion rupees, the equivalent of about $30 billion, through an overnight variable rate repo auction, which is the biggest infusion by the central bank in a single day in over a year. And the increase in the quantum infusion, that comes a day after the central bank already doubled the proportion of government securities that it aims to purchase to 400 billion rupees on Thursday today. The RBI has infused over 1.5 trillion rupees into the system in the last month. And these are more temporary open market operations, though they look like quantitative easing, where the Reserve Bank of India buys bonds in exchange for rupee reserves. And those rupee reserves presumably can be relent through the rest of the money markets, replacing the rupees the Reserve Bank of India took out of them, trying to intervene in the currency markets. It's one spectacular mess, and it's getting worse, not better. In fact, what we're seeing is that the interbank tightness continues to go on long past where it should have stopped, especially given how many temporary open market operations there have been, as well as special repo auctions, not just this week, a whole bunch of other tactics and measures that the Reserve Bank of India is using to try to keep the situation at least orderly. Now, the central bank itself has burned through a ton of reserves going back to September, all for very little gain here. According to the Reserve Bank of India's statements, the level of foreign reserves, total foreign reserves for India fell by 81 billion between the end of September and the week of January 17th. Now, while it came back 7 billion through the end of January, even so, that's still down 10.5% from its peak, which goes to show you just how much and how aggressive the Reserve Bank of India has felt it needed to be just to try to contain and stabilize the rupee, and therefore, hopefully, the stabilized rupee would lead to better financial outcomes, and therefore maybe better economic outcomes. If this sounds familiar, it's exactly like we see around the rest of the world, including China. Intervention in currency markets that's made necessary by difficulties in the global Eurodollar system that are developing based on this world that forgot how to grow, and the various ways in which various countries around the world are forgetting how to grow inside of that overall dynamic. And so the entire tenor around India, the economy, the financial markets, the currency, everything have really shifted over the last couple months because the economic situation has itself really shifted just in the last 6 months or so. According to Bloomberg, climate around Indian financial assets has shifted dramatically since Modi last visited the U.S. nearly 2 years ago. That's Prime Minister Narendra Modi. Then he touted the nation's booming economy, soaring stock markets, and its potential to rival China as the world's factory. Now, his case is harder to make. It's becoming impossible to make, as the Reserve Bank of India could testify. Modi's visit comes as foreigners had pulled $21 billion from Indian shares, at least that's what's been tracked, since the end of September. The rupee has hit fresh lows, and the nation's $4.1 trillion stock market is Asia's worst performer this year among the region's major economies. And the stock market has had enormous difficulties more recently as all of these things are going on. The weakening in the currency, all these interventions, interbank tightness, and the economy that keeps putting up more concerning economic numbers, one after another after another. And I'll get to those in just a second. But the stock market, according to Bloomberg yesterday, Indian stocks ended lower Wednesday, but dip buying by investors trimmed much of the losses after a broad gauge of the nation's equity slumped to its lowest since June. The MSCI India Index ended slightly lower, but overcame a retreat of as much as 1.7% during the day, while a gauge of small caps ended down 0.7% after plunging 3.7%. And these large sell-offs have become a little bit more frequent, a little bit too frequent for authorities' comfort level. The sell-off earlier in the session was driven by persistent worries of higher U.S. tariffs, maybe, and lackluster corporate earnings, the economic connection, leading many overseas funds to seek better returns elsewhere. Quote, the market is in a panic mode, according to Amit Gupta, Chief Investment Officer at FinTrek Capital in New Delhi. And here's the thing, India isn't the only regional market to suffer losses in recent weeks. Emerging market equities across Asia are still struggling as a result of, first of all, the strengthening dollar, which we know is not about interest rates, that's about risk premium and risk concerns, and as Bloomberg continues, the lack of domestic catalysts. And they're being kind here saying the lack of domestic catalysts. What they really mean is the economic and financial consequences of this world that forgot how to grow and the financial disorder and volatility that it is creating. And India is a perfect example of this. Financial disorder, volatility, upset, chaos that central banks are trying best as they possibly can with their limited tools to deal with. So the dollar is simply pricing in all of these fundamental factors and transmitting them and transferring them in all of these different ways to these various places around the world. So when they say lack of domestic catalyst, translation, they simply mean it isn't going well when there were supposed to be booms everywhere, at the very least a soft landing. Instead, the lack of domestic catalyst, that's the consequences of the forgot how to grow and the financial disorder and monetary disorder, banking disorder that is coming out of it. As far as the economic data is concerned, the Indian government just reported a third straight month of negative CPI results. Now, there are some seasonal factors that go into November, December, January. Usually you don't see all three of those months with negative CPIs, but in this time around, that's exactly what happened. So there was negative CPI in November, then it accelerated to minus 0.56 in December, and you thought, okay, that's the typical seasonal pattern. January will turn around, and instead, January comes in at minus 0.97%. So almost a full percentage drop in January after two negatives, November and December. So continuing what should have been seasonal weakness that dissipated. So for the 3 months together, the CPI was down 1.7%, which is an enormous 3-month decline. And the last time you saw anything like that was November 2020 through January of 2021, when the CPI was down 1.3%, even though it didn't fall in all three of those months. And the CPI in India is largely based on food price. In fact, half of the consumer price bucket is food prices. And while in the one sense, that's good that food prices are contributing to declines overall in consumer prices, if it's the rest of the CPI isn't making up for those declines, which means large-scale, broad-based, and sustained, persistent economic weakness, which is leading to now actually lower prices, even though prices should be turning around by now. So for a negative accelerating CPI through these particular 3 months, that's a warning sign all of its own. And while many mainstream observers are suggesting, okay, that just means that the Reserve Bank of India is now clear to cut its rates even more than it has, as Sanjay Malhotra said, yeah, we're going to wait and see how all of this plays out because we're really not sure exactly what we're doing here or what the economy's doing. We see conflicting signals when they're not really conflicting signals, but they're really stuck between a rock and a hard place. It's actually 2 rocks and 3 hard places. Essentially, they've got all of these incoming headwinds, financial, monetary, banking, and economic, and are trying desperately to deal with all of these, almost like whack-a-mole. Every time they try to hit something over here, something pops up over there. The currency gets weak over here, which leads to tightness in the banking sector. Now you've got a hint of deflationary consumer price. Again, don't want to make too much out of it because of the seasonal factors, but it's more than a hint of more than this typical seasonal weakness. So India is a good example of a number of different factors that we've observed around the rest of the world over the last couple of years, starting with the fact that government intervention was supposed to create this panacea, this world of a permanent plateau of prosperity. Even though governments had a large hand in creating all this and inflicting all this damage to begin with, it was sold as it's easy, we're just going to flip a switch. We'll turn everything off and then we'll turn it right back on again with massive doses of government investments and spending and transfers, and everything will just go swimmingly from there. And various places tried various different ways in doing that and to different degrees along the way. And what ended up happening was not what everybody thought was going to happen. It didn't lead to the positive multiplier that all the Keynesians say happens with government stimulus. And instead, the world that forgot how to grow is increasingly coming out of all of these different places. So the global consequences are becoming more and more visible and undeniable. That's what's really bothering the currency, the dollar. The Eurodollar is sensing the global forgot how to grow is becoming local forgot how to grow. India went from a shining beacon of, hey, it did work, to, oh crap, it didn't, all in the space of just a couple months since last summer, proving once again that summertime isn't just the time for recession, it's the time for these countries to remember to forget how to grow. Hey, one of those industries that's really struggling to come to grips with forgot how to grow is oil. And a company, big company within it, Chevron, you got to see what Chevron did in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.